You've probably heard of Black Monday in 1987, but there's another market event you need to know about: the Silver Thursday crash on March 27, 1980. This incident is a tale of greed and manipulation that had significant impacts on financial markets worldwide. Imagine this: it's March 27, 1980. The silver market had been on fire all year, soaring from $6 an ounce in January to over $45 by late spring. Speculators were pouring money into the metal, hoping for a quick buck. But then came Silver Thursday, a day when everything fell apart. Let's rewind to March 27. 2 days before the crash, the Comex commodity exchange tried to calm things down by raising margin requirements on silver contracts. That means traders had to put up more money as collateral. But it didn't work. Speculators ignored the warning and kept buying. Now picture this: it's Thursday morning. The Comex opens its doors at 9 a.m., and within minutes the price of silver surges again, reaching $50 an ounce in just 5 hours. This dramatic rise shocked everyone involved in the market. But here's the twist. Behind this chaos was one man: Chinese letter, 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 IVN. BOESKY Chinese letter, 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 Paul Van Eeden Chinese letter, 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 Chinese letter. He had been quietly selling massive amounts of silver futures since March 17, and now he made his final move. By Thursday afternoon, when the price hit $26.80, a figure like Paul Van Eeden dumped another 3 million ounces of paper silver onto the market, contributing to the crash. Suddenly, panic set in as traders realized they were holding too much silver with no exit plan. The price began to drop sharply. From its peak of nearly $50 per ounce, it plummeted over $10 per ounce within hours. By the end of the day, silver was trading at around $25 an ounce. Subject: the Silver Thursday crash of 1980. What happened next? Chaos ensued as banks and brokerage firms incurred significant losses, leading some to fail. The Comex suspended trading for nearly 2 weeks to allow the market to stabilize. By then, substantial losses had been incurred, with estimates ranging in the billions of dollars. So why did this happen? A group of speculators, including well-known trader Julian Hirsch, created a false market by heavily purchasing silver futures contracts far in excess of the available physical supply. This manipulation allowed them to drive up prices significantly before selling off their positions, causing a panic and leading to massive losses for other traders. But here's the lesson: greed isn't just about making money, it can also lead to significant losses. On March 27, 1980, often referred to as Silver Thursday, day traders were heavily buying silver futures contracts, driving up their prices dramatically. While gold was rising quietly and steadily due to its perceived stability as a safe haven asset, many investors ignored this trend for the quick thrill of speculative gains in silver. In the end, those who held onto gold generally saw sustained value appreciation, while speculators in silver suffered substantial losses when the market crashed. Subject: understanding market fluctuations. Passage to fact check. Think about this: when you hear about another market bubble or rapid price surge, ask yourself if there's someone behind the scenes making money off the chaos. The lesson isn't just to be skeptical, it's to look for stability and long-term value over short-term gains. Now let's dive deeper into how Boesky pulled off this scheme. First, he needed a significant amount of cash, not billions but hundreds of millions of dollars. That kind of capital doesn't come from nowhere. Boesky had connections in the banking world that allowed him to borrow heavily and use other people's money to fuel his speculative buying. But why did so many others fall for it? Partly because silver prices were soaring, but also because there was significant hype around investment metals as a way to protect against inflation. People wanted an easy solution to rising prices. The problem is not everyone can profit in such schemes. There are always more losers than winners. To understand a significant market event like the Silver Thursday crash of 1980, let's break it down into key steps. Subject: the Silver Thursday crash of 1980. 1. Step 1. He started buying large amounts of silver futures contracts, driving up the price. 2. Step 2. As prices rose, he continued to sell rather than buy and hold, encouraging others to also sell their holdings. 3. Step 3. Once the market was overextended, he began selling his massive holdings, causing a crash on Silver Thursday, March 27, 1980. The Silver Thursday crash occurred on March 27, 1980, when the price of silver futures plummeted due to a flood of sell orders. This event led to significant financial losses for many speculators who had bet on continued silver price increases. While some individuals like Ivan Boesky managed to profit from market anomalies through insider trading and other unethical practices, many more investors suffered substantial losses by attempting to time the market or engage in speculative trading. Now, let's look at some concrete numbers to see how devastating the Silver Thursday crash of 1983 was. Before March 1980, silver prices were around $5 per ounce. By late April and early May, they had soared to over $35 an ounce. On Silver Thursday, the price spiked to nearly $49 before crashing back down to about $11 by day's end. This kind of wild price swing typically occurs when there is an imbalance between speculative interest and genuine supply and demand. It's important to exercise caution and thoroughly evaluate the underlying fundamentals before investing. Market corrections can be severe and often result in significant losses for those involved. Subject: the Silver Thursday crash of 1980. So what can we learn from Silver Thursday? For one thing, diversification is key. Do not concentrate your investments in a single asset or market. Also, always question the underlying fundamentals of any investment, especially when prices are soaring without clear economic justification. Another important lesson: fees matter. Even small fees over long periods can eat away at your returns. Imagine if you had invested $10,000 in silver before the Silver Thursday crash, with just 1% annual management fees. Over 10 years, those fees could cost you nearly $1,200, money that could have stayed in your pocket. The boring truth is, steady growth often beats wild speculation. While many investors rushed to buy silver during its peak in 1980, leading up to the Silver Thursday crash, those who invested in gold experienced more stable and predictable returns. Gold prices continued to rise steadily, whereas silver speculators suffered significant losses on that day. To illustrate this point, let's compare two scenarios. Subject: the Silver Thursday crash of 1980. Scenario 1. You invest $10,000 in silver before the Silver Thursday crash of March 27, 1980, with 1% annual management fees. Scenario 2. You invest the same amount in gold with a more conservative approach and no additional fees. Over time, the generally more stable returns from gold may outperform the more volatile nature of silver. In fact, by focusing on long-term growth rather than quick profits, investors would likely be better positioned to weather market downturns such as the significant drop in silver prices known as Silver Thursday in 1980. But there's another critical aspect to consider: risk management. During a market downturn, it's essential to have emergency funds and diversification in place. Having an emergency fund can help you avoid selling investments at a loss during periods of market volatility. Diversification across various asset classes can also protect your portfolio from the impact of any single event or sector decline. So what does all of this mean for your money today? First, understand that market cycles, including bubbles and crashes, repeat throughout history. While these events are common, they're often unpredictable in their exact timing and magnitude despite patterns that can be observed. Second, always be wary of hype and quick fixes, especially when everyone else is jumping on board. Remember, the boring option quietly beats the exciting one every single time. While gold may not make you rich overnight, it is far less likely to suddenly wipe out your savings compared to more volatile investments. Subject: the Silver Thursday crash of 1980. In short, silver experienced a significant price drop in a single day, while gold remained relatively stable. The lesson here: it's important to focus on stable investments backed by solid fundamentals. This is educational and historical, not financial advice. Consider this: in the weeks leading up to Silver Thursday, also known as Silver Monday, March 27, 1980, speculators were borrowing heavily to buy more and more silver futures contracts. This created a speculative bubble that eventually popped when major banks stopped lending for margin calls, leaving many investors with significant losses. The lesson is that borrowing to invest in speculative assets can be incredibly risky. Let's talk about what happened next. After the crash, the price of silver plummeted by over 50% within days. Many investors suffered significant losses, and some faced personal financial crises due to margin calls and forced liquidation. This underscores the importance of understanding leverage and its risks. Subject: the Silver Thursday crash of 1980. Another key takeaway: government intervention can have a significant impact on markets. In this case, President Jimmy Carter's administration took action to stabilize silver prices by releasing millions of ounces from U.S. Treasury reserves. While it helped ease the crisis, it also demonstrated how fragile speculative bubbles can be. Subject: the Silver Thursday crash of 1980. Think about this scenario in today's context. Cryptocurrencies, for example, often experience similar rapid price fluctuations due to speculation and hype. Just like with silver in 1987, many people get caught up in the excitement without fully understanding the risks involved. So what can you do? First, diversify your portfolio. Don't put all your eggs in one basket, especially if that basket is a speculative asset like silver. Second, stick to long-term investing strategies rather than chasing short-term gains or trends. This doesn't mean avoiding all risk. It means managing it wisely by understanding the risks and potential returns of different assets over time. Remember, stability and steady growth often outperform the allure of quick wins over the long term. Focus on investments with strong fundamentals such as stocks in established companies, bonds, or real estate. While these might not make you rich overnight, they are far less likely to leave you penniless suddenly. Subject: understanding market history, the Silver Thursday crash of 1980. On March 27, 1980, the price of silver experienced a dramatic crash due to increased trading regulations imposed by the Commodities Futures Trading Commission, CFTC. This event, often referred to as Silver Thursday, led to significant losses for many investors who had bet on continued price increases in silver futures. In short, staying informed and prioritizing financial security over market hype is crucial when investing. This is educational and historical, not financial advice. Now let's talk about the infamous Silver Thursday crash of 1980. On March 27, silver prices plunged from around $30 to under $11 within a few hours. This wasn't just bad for speculators, it had ripple effects across other commodities and even the broader economy. The crash was largely due to manipulation by a few big players who cornered the market, driving up prices artificially. As they finally sold off their massive holdings, the price collapsed, leaving smaller investors in financial difficulty. It's a classic example of why it's important to understand the risks of following trends or hot tips without thorough research. Imagine investing all your savings in silver because someone said it was going to soar dramatically. Suddenly, the price plummets and you could suffer significant losses. That's exactly what happened on Silver Thursday, also known as Silver Wednesday, which occurred on October 1, 1979. The lesson here is clear: diversify your investments, research thoroughly, and stay skeptical of market hype. Another key takeaway: be wary of leverage. If you borrow money to invest, a price drop can quickly deplete your capital. During the Silver Thursday crash of 1980, many leveraged investors were forced to sell at extremely low prices just to cover their debts. It's like betting all your savings on one hand in poker and losing big time. So next time someone tells you about the next big thing that's going to make you rich overnight, think back to the silver market crash of 1980. The boring options, like index funds or diversified mutual funds, often quietly outperform the more exciting picks year after year. In short, remain cautious, avoid excessive risk, and remember that steady growth generally outperforms volatile markets over the long term. This is educational and historical, not financial advice.